Sunil Subramaniam is also joining us from Sundaram Mutual Fund. Sunil, afternoon. One section of the market really liked the budget a whole lot, especially the way yields came back. Just earlier, our panelists were also making a point that this is much more meaningful than what the street is realizing right now, because it could lead to lower inflation going forward and hence rates going lower. What are your thoughts on it, especially from the stock market point of view? The valuations, what will it do if the rates and inflation actually heads lower in the next coming months? What could it do to stock market valuations overall?
The first thing is that this has multiple implications. The first point is that the crowding out effect of the government will be much less, leaving that much more capital for private sector to raise, right? So I think that's a very important thing, because when government comes and borrows a lot more, they crowd out the private sector and then interest rates rise at that time. But because the government has announced a much lesser borrowing program for next year, it creates room and space within the space for the corporates to borrow as and when the Capex program of private sector starts. Now, bear in mind that's not yet happened. So when that happens, I think the government's decision means that there's enough liquidity and bank funding available. That's a very good news from a capital market perspective, because otherwise banks' NPA ratios have been declining, credit upgrade ratios have been improving. So everything is well set for the Capex cycle to start. So that's the best news from a medium-term perspective, that this is an additional supporting factor. The second factor is, if the government is borrowing less, then the pressure on yields, when crowding creates the space, it also reduces the pressure on yields. So what this does is, obviously banks, so PSU banks, for example, who have large holdings in excess of the CLR requirement with the government, right? They can have mark-to-market gains on the portfolio. So for the banking sector, this is a positive, which then spills over to mutual funds also, who have significant allocation to banking and financial sector because they're a big part of the index. The third aspect of this whole less borrowing program which comes into the market is that from a debt perspective, right? So last year in the finance bill, if you remember, the indexation benefit for debt was removed. So what has happened is that this year, the entire focus of people wanting to take advantage of interest rates has been through hybrid mutual funds, which have an equity plus debt combination. Because once you keep 65% in equity, so you have balance advantage funds, aggressive hybrid funds, multi-asset allocation funds, all of which, bulk of them keep equity at 65% and balance they put in debt. Now, because of this reduction in the interest rates in the the debt securities market, these balanced funds, which remain now the only way for a person to participate in a reducing debt market in a tax efficient manner, is through hybrids. So you will see a lot more money flow into hybrids, and because they flow into hybrids, there'll be a lot more money for buying equities also from that. So it's a double-edged weapon in that sense. Securities will get more subscription, but equities will also get more buying power from allocation of flow. So again, it's a very big positive. So I see this. Second aspect is that the fact that the finance minister has projected not only lower market borrowings, but a lower fiscal deficit, with a confirmation that 4.5% of FY 25-26 will be held, means that from a rating perspective, if India's growth numbers start to look even better than they are, then there's a good chance for India an upgrade to happen. So if an India gets rating upgrade, whatever, if during the course of the year, that's a fantastic positive for the equity markets. And top of all this is that the bond index, right? We are in our inclusion from June, which is another fillip. Now, if that government is going to allow that money to come in, that will give a further downward pressure on yields and hence strengthen all of this that I'm talking about. So I think this report card budget, which is what I would like to call it, because largely it was a report card, has given all the positive signals for the equity markets, because equity markets love lower interest rates, period, as an overarching thing. So I think it's a huge positive. Today, the market may not be reacting because probably anticipating a lot of benefits and all of that, certain things had gone waiting for that. Maybe that's not happened, but that's okay. Today's market reaction you can ignore. I think this is a very good interim budget.
Yeah, of course, the near-term moves are something, but that was a comprehensive take in terms of what are the different angles one should look at in terms of the budget. But if I can make it more stock-specific and bring it to you, Sandeep, last year it was all about urban consumption and the kind of K-shaped recovery and the luxury kind of the market which was doing well. This year, do you think on a risk-reward basis, it's better to have your portfolio more skewed towards rural, cyclical, the likes of, cement, even other rural plays like base, staple, FMCG, etc.?
I think consumer names like FMCG, many of those companies are trading at relatively more near 52-week lows rather than 52-week highs when the market's at 52-week high. So risk reward is much better because, as I said earlier, I expect volumes to improve going forward, and that could directly percolate down to the sentiments around those stocks. Many of the consumer durable stocks are also subdued, so I think there's opportunity there. And I believe autos will continue to do well, and I think that's one segment which continues to do well.
So let me actually put it a bit differently. Is it time now to book your profits out of those luxury names which are doing well? And I'm talking the ethos and the the winemakers of the world and those high-end luxury kind of names that were doing quite well, even Titan for that instance.
So I think many of these companies have proven themselves over a long period of time. For example, like I would not go out and buy Titan at this price.
Okay.
But if someone is holding Titan for several years and it's been such a consistent performer, do I tell them to sell at this price because in 1 quarter or something they don't do well? I wouldn't say that. So if you are holding, you keep on holding such companies because the longer term growth prospects are good. But for someone who wants to buy now, I think the valuation might be excessive. So you wait it out and wait for corrections. And
what you said is right. The confidence of the finance minister comes on the back of huge success that you have seen on various programs that the government has rolled out, mainly to uplift the Indian economy to where we are today. And it also reflects on per capita income which has been rising purely on the basis of various social benefits they are given. And second, the huge emphasis that they are given on the infrastructure investment of the country has been yielding the right results, both in terms of the economic growth going past 7%, and tax collections have been showing a continuous improvement. Month on month, we have seen GST collection showing an improvement. Plus, various the compliance part now getting more or less getting fulfilled, putting this fiscal target for next year, which is what I probably say that reflects the confidence of the finance minister that how the tax collections have been shaping up in the country, which is one of the big agenda of the government is to make the tax to GDP ratio to keep going up each year. I think that shows the confidence of finance minister to set the target for fiscal to 5.1%. I think, and the last but not the least, actually, is continuing to keep high focus in terms of the government spending, which of course has got about 11.11 lakh crores, which is about 11% increase. I think people are saying the 11% increase is small. I think we have to look at this from the context that initially when the government was pushing it, they were alone. There was no, of course, private sector participation was coming in, private capex improvement. Now, the last 1.5 years, thanks to PLI schemes, and the government keep asking questions why private capex is not picking up. Now, private capex actually today is growing faster than the public capex. I think both combination put together, I think the vote on account budget, generally we don't keep any expectations. In fact, the 58 minutes speech of the finance minister, I think threw up a lot of things which I think all of us should feel happy about the certain growth momentum as we move forward.
Bala, the once not preferred, to put it mildly, sector, the entire PSU basket was clearly the darling of 2023. How are you reading into the fact that the divestment target has been set at 50,000 crore rupees and all the announcements made on that front? What does that spell ahead for the PSU space as a whole?
I think the PSU sectors, I think will continue to be one of the beneficiary for two reasons. One, efficiency which are the public sector companies have been on the way up. One, from the leadership point of view, and second, the huge potential that they have been having as a business per se are now being unleashed, given the fact that government spending has been rising. And third, of course, is the re-rating. I think most of the companies were trading below the one-time price to book or trading at half a time the multiples. I think some bit of re-rating also is happening. And finally, each of these public sector companies have been making huge investments, both in making the future ROE look much better. At the same time, they make huge investments on growth story. Being the public sector companies, they have been the biggest supporter of the government in every respect to ensure that they do participate in the overall growth momentum. My own belief is we will see the public sector companies selectively continuing to remain in the radar and will be part of the market in terms of price momentum. Purely on the basis of the fundamentals of all these companies are getting better. Maybe the time will come, we will hardly find a difference between the private sector and public sector from the management capability point of view as well as from the business execution capability point of view.
Right. Sunil, what are your thoughts on the earnings quality, coming so far, especially on the top line front?
I think it's not been great. I think it could have been better. I think coming after the delayed festival season, the numbers we were anticipating should have been much better. So honestly, they have not been great. It's fairly tepid, if I would say, but it's not fully done yet. We'll wait and see. Certain numbers like the auto numbers, I think, which have come out very well. I think the broader market auto premiumization was already evident, but at the lower end of the cost curve, there wasn't there. And I think today those numbers have started coming in and looking better. So I would still wait to give a final judgment, but the initial ones have been a bit tepid. That's what I would say.
Bala, look at the financial space pretty closely. This entire fear of some of the large banks, not posting very high growth in an overall environment where credit growth is pretty decent. Is it some specific company to company issue, or overall large caps are not being able to capture that much of credit growth as some of the mid cap banks or even NBFCs, microfinance are doing?
I think, Ajay, clearly, I think there has been a big differentiation that has happened in the last few years. I think the larger the banks were going at the same rate at which they were growing before, I think that's becoming a little difficult given the fact that the size is very large and the cost of their deposits is really low. Therefore, they can, ideally speaking, offer a very fine rate of interest. At the same time, given the fact that the financialization of the country and reaching out to every nook and corner of the country largely happens through the smaller size firms, I think we are seeing actually significant growth coming from that as well. I think as it happens in any other industry, once you become certain size in terms of large size, and whatever the premium value that you get because you have been growing faster than industry, and now having seen peak size, then definitely you go through actually a period of consolidation. That happens in most of the industries, that happens in the bank industry as well. But at the same time, there are many public sector companies, actually as NBFCs, microfinance companies, who do not have a very large size in terms of balance sheet. At the same time, they are actually penetrating into the bottom of the pyramid segment, or maybe the mid segment from a growth perspective. Therefore, the rate of growth has been pretty interesting. And that's what I think we are seeing in the market today. If you look at the performance of companies, I'm talking only about the stock price performance as well as result performance. There's a clear difference coming mainly on the back of the smaller side. The rate of growth will be good. Therefore, some bit of benefit that accrues to them. A bigger size companies, they go through their own consolidation period, which normally happens in every segment of the market. I'm sure a similar trend is being noticed today as well.
Stay on with us, Bala, as well as Sunil. I want to come to our chartists as well, who are waiting by just about 10 minutes to go for the markets to wrap up today's trading day. Just purely, Kunal, going by the way the charts of HUDCO, NBCC and BEML along with SCI have panned out, what are your charts looking like?
Yeah, so I think looking attractive. In fact, HUDCO was something which I recommended in the morning, expecting the stock to give double-digit returns. So it's finally managed to do it. In fact, my targets were closer to 185, 186 for HUDCO. The stock has now crossed 200 levels, so looks very attractive at current levels. NBCC also, I think, has given a classical breakout above 140 mark. So again, a stock which has done exceptionally well in the last 1 year and continues to show promise even from a short to medium term perspective. Volumes are back again for these stocks, so that probably substantiates the move for many of these stock names. So looks attractive, and the setup across the mid caps and small caps is completely different than how the index setup is. The only one factor which is also intriguing for the markets today is the drop in India VIX, which is back again below the 14.5 mark, of course with the event out of the play. So that should probably also help volatility subside over the next couple of days for the markets as such.
Naresh, coming on some of those fertilizer stocks in trade under a bit of pressure?
So a lot of these fertilizer names went up quite a bit, whether it was a RCF or a Zuari Industries or something like Fact, which has seen a very speculative move wherein the stock has gone up one way, the market cap is higher than Coromandel Fertilizer. So a correction would be normal in this case. I would expect some more correction going forward in all those names. So maybe another 5-8% from current levels.
Bala, one last question before we let you go. Between now and the next budget, there are a few months, there are elections. How do you see the direction, I would say, or the environment, the macro environment which the markets are operating in? Any imminent fear? Is earnings risk an issue or something else which is there on your radar, or broadly things look okay?
Broadly, I think it's okay, Ajay, for one simple reason that pre-election, generally the active levels pick up from the spending point of view. And second, the good harvest season should lead to a spending comeback. And third is the interest rate environment post this fiscal number. While there has been a good rally that has happened in the bond market and the government securities market, I think we should also see this as we move forward, bringing the interest rates before even RBI start cutting rates, especially on the lending side. We could probably see some bit of moderation happening. I think overall basis, if you look at, I think the momentum should continue. From the stock market point of view, of course, valuation could always be a concern. Not that the concern is there today. It was there 3 months back as well, about 6 months back as well. Valuation concern always been there. Market, of course, have now got that trick of punishing stocks which were the results are not that great. All on a single stock basis, it gets punished. And therefore, one should not pay too much attention at this point of time. Valuation is something one should worry. I think one has to remain stock specific, sector specific, in order to ensure that you remain hedged in this kind of market from an overall portfolio perspective.
So, on the valuation front, Sunil, are you also of the view that certain pockets of mid cap, small cap are getting frothy, or it's not right to paint the entire thing with the same brush?
So I think it's not an easy question to answer, because you see, what's happened is that you mentioned mid and small cap. So let me tell you that a significant proportion of the mid and small cap universe and index is linked to the infra space, to capital goods and infra and defense and manufacturing. Now, while the government has continued its emphasis in this budget also around that space, it is a fact that private sector Capex has not picked up as anticipated. It is getting delayed. And the reason for that is that the consumption numbers of the mass market, right? Premium consumption has been going up, but the mass market consumption has not gone up after the second V-shaped recovery after the COVID. So it's got stuck at about 76, 77% levels. And unless there's a strong breakout in terms of the consumption growing, and hence the capacity utilization threatening to go past 80, then a private sector Capex, which is in the talk today, will have to get converted to action, right? So in that run-up, right, what is going to happen is first consumption needs to go up. And today we are seeing the signals of that. If you see the auto numbers coming in, you see the FMCG numbers coming in. So I think that those have to go up first before the private sector Capex can start. But capital allocation wise, over the last year and a half, the capital allocation has moved towards infra at the cost of consumption. Now, prior to this this month and this January onwards, the banking sector had got allocation too, because NIMs were widening everything. But this month you've seen a big correction in banking. So what is happening is that the capital allocation, I feel that within the infra space, the valuations are, I think, looking on the richer side. So I would expect capital allocators who actually look at valuations to allocate capital to shift money away from the infra space, albeit that the budget has been pro-infra, into the consumption, because I believe those numbers are going to start looking better from an earnings season perspective, especially in the run-up to the election. You will see a lot more money flow down to the bottom of the pyramid of the economy, and you will see the mass FMCG and the low-end consumption numbers pick up. So this capital reallocation will mean that overall, the market may consolidate, may move slightly higher, but within it, I believe there will be a leadership from...
Right. All right, Sunil, thank you for taking time out and sharing your outlook on the budget.